All right, welcome everybody. Thanks very much for being here. We're going to get started. Welcome back to our regular quarterly review of the markets, what's happened in the market and economy over the last few months, and as we look ahead, what we might expect and how that will affect your portfolios. We'll be talking all about those kinds of issues in this presentation. When it comes to this presentation, though, be aware it is being recorded, and any questions you might ask will be available for our clients and will be posted on our website in our client section that may be heard by others. Let's begin. Just introductions. Most of you probably know I'm Chris Boyd. I'm the founder and the CEO for our company, Asset Management Resources. Brian Regan is our Chief Investment Officer, and he will be conducting the bulk of our presentation today. And with that, I will pass the baton to Brian at this point.
Thanks, Chris. Some background noise there if you want to mute it. So the first thing we like to do every quarter is we like to give a review of the changes that we made in Q3 and how it worked out. So many of you might remember that we made changes where it came to our bank loan fund. We moved from a Fidelity fund to a Catalyst fund. In the short run, we expect these funds to be very comparable. I don't see, big changes, but in the longer term, the Catalyst fund had a better risk-reward trade-off. So we're going to maintain that fund, and if you're still in the Fidelity fund, it's because of fee reasons, and you'll eventually be moved out. We made the assessment that the NASDAQ had a very big run going into the third quarter, and we wanted to take a little bit less volatility risk in the stock market. So we decreased our beta exposure, and we decreased the QQQ. We kept the QQQ, the NASDAQ 100, in most strategies, but we just reduced it. This strategy, the QQQ still outperformed, but it was very volatile. We saw a big sell-off in September, and basically, given whatever day it is today, whatever day it is, depends how which fund outperforms. So in the short run, QQQ is still doing well. We still feel confident in that move with USMV. We still were positive on performance. So that's why that's blue. We increased our overall stock exposure by approximately 10%. This came from our view that stocks were closer to fair value than people might have previously expected in prior quarters after the coronavirus first hit the market. Stocks performed well in the quarter, so it worked out well for us. And a smaller change in the dividend portfolio, we moved from FDL to DGRO. And this is similar to the bank loan change from Fidelity to Catalyst. It's more of a longer term change, but we do believe DGRO still outperformed in the quarter, and normally I would make that green, but since we're not really evaluating that change on one quarter, I kept it blue. So the way we view the market right now is really kind of in a two-act play, right? Act one is the shorter part of the play. It's probably only going to be a half hour and a 2-hour play, and this is the one that we're all very familiar with. I think we have obvious risks with coronavirus and COVID. We have a big election on November 3rd that depending on your political affiliations, I tend to get favorability in one way or another on the market in our phone calls and our conversations with people. I think it's important to note that we've had a bit of a recovery in the economy, but still down at historic levels. And stock market valuation is, given the risks in the market, the expectations that we have for future earnings, and the certainty that we have on interest rates for the foreseeable future, is about at fair value today, and we can get into how we came up with that. Act two is where a lot of these uncertainties get taken off the map. So we're going to have a vaccine, or at least we're going to have data on a vaccine. Pfizer, for example, came out today and said that they expect to that they could possibly have an emergency use authorization on a vaccine by the end of November. We're likely going to have stimulus regardless of which party wins, and we can break down, the policies that we expect and how we expect it to affect the markets. Generally speaking, I think the market will react positively just just knowing who the president is for sure. And we do know that by January 21st, one way or another, we are going to have a president. Worst case scenario, it becomes the Speaker of the House if there's no resolution. We're going to review how there's a tale of two markets. If you've been in exclusively growth stocks, you've done extremely well. If you've been on the other end of the spectrum, you've done extremely badly. And that's probably not going to last forever, the scale that's happening. And then I want to take a quick look at commodities, specifically oil and the disconnect that oil stocks have had from the actual commodity itself. I want to talk about small and mid caps, and I want to review gold real quickly. Now, finally, we talk about risks and every quarter, and I just don't. And sometimes they can get overshadowed by things like coronavirus, which might be the right thing in a given moment to be overshadowed. But it doesn't mean that they necessarily go away. So I just want to touch on them quickly, so we don't forget about them, and we keep them in the back of our mind as we're managing portfolios. So first, we're going to talk about, Act 1 of the play and how we expect it to, we're going to outline the risks and the opportunities and how it's really playing out. We're currently in Act 1. Obviously, case growth has increased. This chart is pulled from October 3rd. I think it's actually gotten worse since then as we're starting to move into a third wave, in certain parts of the country, specifically the Midwest today. The first wave was really the Northeast. The second wave was kind of the Southeast, and the third wave here has been the Midwest. But generally speaking, the death rate has been lower, so that's been positive. Chris, you want to take over the electoral map here?
Yeah. Before we do, I see we have a question from Ron, and maybe I'll see if I can identify how to answer his question here. Ron's question is, today the Washington Post had an article on the Barrington Declaration proposal to address COVID-19 versus the strategy being followed here in Massachusetts. Does the medical debate have financial implications?
Well, I haven't read the article. I'll look into it, but I think anything to do with the COVID has financial implications right now. Ultimately, I think what we're saying is what's going to get us into a stage 2 where we're very optimistic, or more optimistic based on certain these big risks starting to be taken off the table, has to do with the vaccine. So anything we can do to get closer into that Act 2, I think the better.
I think the nature of that issue is the question of things related to that herd immunity and the measures of whether that's a plausible best approach at this point in time, something to that effect. Well, we can come back to, sorry, go ahead.
I think it's kind of obvious, right? If we open up businesses, it's going to be good for profits, but a lot of people are going to die. I mean, it's the ultimate trade-off that we're all dealing with, right?
Right.
So sure, probably be good financially, might be bad overall, morally and ethically. So I think that's my simple take on that.
Okay, thanks. With regard to the electoral map, we're paying attention to this very closely. It's in flux, of course, and things can change. And we do know, from past experience that polling isn't always predictive. And so we're very attentive to that. But the way things stand today, it looks more like an outcome that will favor the Democrat Biden candidacy on the basis that, of the states that right now are statistically too close to call. There's a handful of them here, and I guess that's a greenish color. If even if the president were able to retain or get the lead in all of those, the way the math still presents, it still would be an uphill climb. It would lean toward a Biden presidency. They would need to be capture all of the too close to call states and flip at least one, possibly two, like New Hampshire and Maine together, of the states that are in light blue, whether it's Pennsylvania, Michigan, Wisconsin, Montana, Nevada. So it's an uphill climb at this point for the Republicans to retain the White House. That being said, it's still in anyone's game at this point. It's very a close race. But looking at the electoral math, it does seem to favor a Biden outcome. I would also point out that, we're very much paying attention to what happens in the Senate as well, because that is an extraordinary close race, and how that plays out can have an impact on policy. When it comes to this issue of the electoral math, we could get a closer look here and seeing states like Arizona, Florida, Michigan, and so forth. There's all these states that in the 2016 election, the Trump candidacy carried into the, to win the election. We see here that the amount by which they won on one column versus how much of a deficit they're running in the polling currently. Again, this is predictive and things can change, but it indicates that it's notably challenging right now. And what Brian has put on this page also is perhaps a contributing factor that may explain some of that, and it relates to the unemployment claims that are happening in these states and how the economic conditions currently can be a factor in impacting the outcome of the election. Brian?
Yeah, thanks, Chris. So I want to talk about the shape of the recovery. I think, this chart is about unemployment claims, and it's the state one. It's not showing the initial state claims. So we obviously saw a huge jump in April in the early stage. We were having almost 7 million claims a week. I remember seeing the charts in the newspaper where the claims in the past were compared to what we had in that particular week, and the red line ran all the way up the side of the newspaper. And so, obviously, when we're in a healthy economy, when we're running 200,000 claims a week, 7 million is a huge jump. But we've had a decent recovery since then. I think helped by the CARES Act and the general recovery of the economy as we've opened up in places and had starts and stops. And it's gotten progressively better, but we have plateaued, which is most concerning to me. So we had kind of had the theme of this is we've had a sharp V-shaped recovery that has slowed dramatically. So it remains to be seen if we're going to continue into a U or an L. My base case scenario is that we're going to continue into a U once we start to get vaccines distributed widely, which will happen throughout 2021. But the stock market's going to react before that, and that's important to note. So this is some high frequency data. This shows that the only thing that has progressed past where we were pre-COVID is the growth in mortgage applications. So we've seen this in housing stocks and home builder stocks that have done exceptionally well as of late. And we, generally speaking, this is the trend that people are moving to bigger places due to COVID, and it's really accelerated by it. Helped by extremely low mortgage rates. Everything else you can see in the travel and leisure here has been hurt significantly from TSA traffic, U.S. seated diners, travel and navigation, app usage, hotel occupancy, all far below where they were pre-COVID, but they've increased off the bottom. So again, we had a pretty rapid recovery from zero, but now we're slowing down dramatically. One of the things that I do want to point out here is that debit and credit card transactions are almost at pre-COVID levels, which is a very important indicator for things like consumer discretionary investments. So I just want to revisit this quickly. We do have a tale of two markets. If you were in the Russell 1000 growth, year to date, you had done 24%. If you were in Russell 1000 value, you were down minus 10%. Why is this? Well, generally speaking, the stocks that are benefited from people being at home are in the Russell 1000. The people who in the stocks that are in that would benefit from people leaving their houses are in the Russell 1000. You could reasonably expect that this could flip, if we had a vaccine in Act 2, but I'll talk about more about that when we're in Act 2. But this is revisiting a lot of what we talked about last quarter, and this trend is continuing, although it has slowed down. So, that's part of the reason why we reduced our exposure to QQQ last quarter. Chris, you want to take stock market valuation here?
Thanks. One of the things that we pay attention to routinely is trying to assess whether the market is overvalued. And at present, there are indications on one hand that it does seem to be trading at a high multiple. When we talk about the price to earnings ratio, remember what that means is that we're looking at what the earnings of a company are and saying how many times that rate of earnings would it take to justify the current price. And at present, it's over 22 times the earnings of the S&P 500 based on what's projected forward earnings, which is relatively high. As you can see on this graph, ordinarily the 25-year average comes out somewhere closer to 16 and a half. So on the one hand, you might think that we might be elevated and poised for a pullback or some kind of worry. On the other hand, though, there are other factors that go into thinking about this. And one of those is the notion that interest rates are extraordinarily low. And there's very few places to go for a competitive return. When we think about the yield we can derive from the S&P 500, it's probably better than we would get from treasury bonds and as an alternative. So plus the potential that it could ultimately appreciate over time. So on the one hand, we have the expectation that things seem a little bit elevated, but on the other hand, the comparison of where we might go for an alternative might justify some of that. When we add in the notion that we think that there's a opportunity to recognize a vaccine on the horizon. We don't know how soon, but we envision that it's on the horizon. And it looks like it's going to be, if not this quarter, that there's some kind of announcement, likely next quarter, that will have the awareness of how the vaccine will play into our future. And that would give an opportunity for earnings to improve within the forward earnings estimates for many companies. And so that might change the math of what we look at when we question this valuation. So we think it's relevant to recognize that we're perhaps on a high end of valuation, and Brian's going to talk about this more, but it's also probably in the notion of a fair value. So I'll turn things back to you, Brian. If there's anything you want to add to my comments there, feel free.
Yeah, the only thing I'd add, and I think you did a great job summing it up, Chris, is that this line could actually come down without the stock market going down. And the reason that could be the case is earnings expectations would rise as expectations that we would get back to normal increased. And that can just happen with time. So, it might look ugly now, but...
So it doesn't have to mean a volatile market for this chart to more normalize to get back to that, closer to that average number.
Right.
Could simply be increased earnings potential to change the math on the equation.
Right. So here are some things that I am worried about, though. So we can see from January, February, April, May, June, July on the left-hand corner. Obviously we had a big spike in temporary layoffs, but what I'm most concerned about is how many of those temporary layoffs are becoming permanent layoffs. This makes it a lot harder for the economy to recover. Most importantly, it makes it a lot harder for people to apply and get credit, which would hold back the economy greatly. On the right-hand side, it's ultimately showing the same thing. We had the labor force participation rate is just falling off a cliff. It's about the same amount that we've lost during the financial crisis, but we lost it very rapidly. And it remains to be seen how that will spill into the economy. I would expect it to have significant negative impacts on the credit picture. However, the credit picture has been supported by the CARES Act, and if we get another stimulus package, I would be less concerned about these two particular charts. So that being said, stock market valuation, more specifically, we've upped our fair value estimate to 3,200 to 3,400. Today, we're a shade over 3,400 on the S&P 500. I think it's important to note that this is all based on the S&P 500. Why is that important? You know, the S&P 500 isn't a representative of the mom and pop industries that might be in your neighborhood or on your street. Apple and Microsoft both saw revenue growth in the last 2 quarters, where I guarantee you the closed restaurant in your neighborhood did not. So, you know, the stock market can increase earnings without, you know, really without being opened up. But consensus expectations are that 2021 earnings are going to surpass 2019 earnings. Even when I give that my normal conservative haircut, we still get to these numbers. Now, there is upside. You know, I put a 0% chance of a V-shaped recovery here. Why do I do that? Because I think we've definitely seen that the V part of our recovery has stagnated, and we're more of an L, and hopefully moving toward a U as we get new info here. But if it continues in a U-shape, it wouldn't be outrageous if we were between a 3,500 and 3,800 on the S&P 500. But you know, we probability weight things here, so which keeps us out of taking excessive risk. And when you do that, when you start to take into account the possibility of an L-shaped recovery, which would happen without a vaccine and without stimulus, you get something like 32 and 3,400.
Brian, would you also just make sure people understand the difference between an economic recovery, you know, U-shape expectation perhaps, versus a market recovery, which maybe more accurately has seen a V-shape, and that disparity?
Sure, they're related, but they're not one for one, right? And you know, I was trying to get to that a little bit when I was talking about the S&P 500 and earnings expectations, right? So, you know, Amazon, Microsoft, Apple, they're not your mom and pop shop. That might be more reflected in economic numbers. But the people, they might buy their products from Amazon and Microsoft and Apple. But, you know, we're expecting earnings, despite all that, there's consensus, not just my thought, that we're going to have earnings in excess of 2019 and 2021. So even though there's a lot of people unemployed and there's a lot of things in bad shape, some of the companies that are overwhelmingly driving the market forward are doing pretty well. You know, I was looking today, Amazon, Google, Microsoft, Facebook, and Apple make up 22% of the S&P 500. So, you know, if they do well, the S&P 500 is likely to continue to do pretty well. So then we're going to get into Act 2. So Act 1, there was obviously a lot of risks, you know, with election, with with COVID cases getting worse, a lot to be concerned about. But the good news is it's going to be a relatively short period, right? And the stock market is forward-looking. So, you know, Chris, do you want to tee up what we're thinking about here?
Well, just to elaborate on your point, you know, we do see this happening in stages. There's initially, we've got some things that are on our horizon that we know are unknowns, and a little bit of concern and volatility may ensue. But we recognize that come next quarter, there's going to be more predictability. And that's going to affect the way we think about how to deal with that volatility in the near term. And we're going to elaborate on, you know, why we think there's a brighter future down the line in this next segment to talk about this Act 2. But ultimately, you know, having that in our sights impacts how we think about what may be coming in the months ahead if we have volatility, which we're not even certain that will be the case. But if we do, we see that as an opportunity, not as a worry. So Brian, you take it away and dig into the parts of our Act Two, I guess.
Yeah, I mean, I think my line that I like to tell people, that just to piggyback on your point there, is that stocks are long-term assets. The short-term discounts are, give us the gift of cheap valuations. We should take advantage of that. So, I think the market's gonna every day that ticks by is gonna be more concentrated on Act Two and less concentrated on Act One, and that's important to keep in mind. So, vaccine. This isn't pie in the sky stuff. We have a number of companies here that are in phase 3 trials, and even 3 more who plan on being in phase 3 trials before the end of the year. Pfizer gave us some good news today, where they are hoping for emergency use by the end of November. Johnson & Johnson had a bit of a setback, and we haven't had any recent data from the other folks. It takes some time to get phase 3 data, and the reason why is, Johnson & Johnson is going to inject 30,000 people with the vaccine. Well, no, they're going to have 30,000 people in the trial. They're going to inject 15,000 people with the vaccine, 15,000 with placebo. And what you need to have is at least 150 to 200 people come in exposure with the virus, and to see how it reacts, in order to get some data that you can publish and hope, and hope for some approval. And that just takes time, especially with everybody trying to avoid the vaccine. But maybe as we get into the fall and winter months, it can actually be accelerated, which I guess that's the only good thing about having more COVID cases, since it's pretty terrible.
Yeah.
I want to talk about the policy breakdown. We are going to have a new president next year. It's most likely going to be Joe Biden or President Trump. Even if there is a contested election, the contested election would be part of Act One. We're talking about when we have a president on January 21st. There's a small chance it could be Nancy Pelosi. So if Joe Biden, I got most of these policies off his website. Actually, all these policies off his website. And I break it down first. We're going to go through how it's going to affect risk assets, which I consider to be stocks and high yield bonds, very generally. And then I'm going to talk about how I expect it to affect economic indicators and investment grade bonds. They proposed a $3 trillion stimulus package.
And just to be clear, and you'll also run through, if it's a Trump presidency, what those policies and prescriptions would look like for the.
We'll cover both. Yeah.
Yeah, just to let people know.
So a $3 trillion stimulus package to support the current pandemic problems that we're having. So $3 trillion is 14% of current national GDP. So loosely speaking, I would expect that to increase stocks by 14%. I would expect it to increase high yield bonds by 7%. It has state and local and tribal aid. This should be good for municipalities. It has extension of crisis unemployment insurance. This should be good for consumer discretionary stocks. It has significant small business support in it. It should be good for small cap stocks. And it has a government health program, which should also be good for consumer discretionary, because if we're more comfortable going out in public, we're going to spend more money in stores and restaurants. So it naturally help consumer discretionary companies. Now, taxes. We had a
Brian, could I, before you go on to taxes?
Sure.
Just so that I'm sure one of the questions is, how do you come up with a 14% without going into a lot of the minute detail, just an overview, how do you come up with a number like that?
Yeah, it's not rocket science. I took $3 trillion and I divided by national GDP, and I got to 14%. So 3 trillion divided by 21 trillion, basically. And if I get my numbers correct in my head, and you get to 14%. High yield bonds react to about 50% of the scale of stocks, so I just divided it into, and that's 7%.
Very good.
Because
okay.
My guesstimate, I imagine, is going to be highly directionally correct, if not completely accurate. Here.
Terrific, thanks.
And then you'll see, the current corporate tax rate got lowered from 28% to 21% in the last administration. And we saw it was very good for corporate earnings. We raise it back up to 28%. Well, then I think earnings would be lower by 7%. I do think some portion of this is already baked into the prices of the stock of consensus earnings. So there's an expectation that Joe Biden's going to win the presidency. There's an expectation that corporate tax rates are eventually going to go up. That naturally, I'm not the only person that knows this. This is consensus information that's going to get baked into consensus earnings expectations. However, for the sake of conservatism, let's say that stocks go lower by 7% because of the corporate tax rate. If you do a $3 trillion stimulus and you raise the corporate tax rate, it should still be positive for stocks. I'd like to make clear that I think it would be very unwise to raise the corporate tax rate in year one. I would expect it would most likely happen in year two, especially if the Democrats have control of the Senate. So he also wants to raise the minimum wage to $15 an hour. I think generally this would be neutral, but it would be great for consumer discretionary stocks. And you'll see that consumer discretionary stocks are going to be a beneficiary through a lot of this, regardless of who's president. He has a manufacturing innovation plan. I think generally that's only going to help union workers. And then they got the $2 trillion clean energy plan. Again, this is going to be it's going to be helpful to stocks. It's going to 9% higher. Again, take 2 trillion divided by national GDP, and I get that 9%. And it's going to help high yield bonds again. And what's this going to help? This is going to help the industrial, energy, materials, and unions. But when I say energy, I don't necessarily mean oil. I think it could help clean energy. It could definitely help materials, specifically, copper, natural gas, gold, and different industries. This is going to be kind of a company-specific winners and losers type thing. And I think this is less likely to pass, especially if the $3 trillion stimulus gets passed. But when you do up the math here, the overwhelming amount of stimulus that we have is likely to be beneficial to risk assets rather than negative to risk assets. Now, the story for a Trump presidency is very similar. And this is, if you've talked to me recently, you know that this is what I've been preaching one way or another. The Republicans also want to do a massive stimulus, north of 1 trillion. I think the last number I saw was 1.8 trillion. It seems to change based on the day, so you might have a different number in your mind. But that gets stocks 5% higher. He wants to lower payroll taxes. That's been a recent plan floated. That should be a boom to the stock market. Again, consumer discretionary and small cap stocks will be the beneficiaries of all this. Just to give some kind of reference, the stimulus package that was done in the Obama administration after the Great Recession was only $800 billion. So when we're talking numbers, and it set off the bull market for 12 years, right? We basically bottomed soon thereafter. We've already had $3 trillion, give or take, and now we're going to be adding some more trillions to it with a T. Some real massive numbers here. So, it's hard not to like risk assets if these stimulus measures pass. And since both parties want to do a big one, and I think it's likely to happen in the lame duck session, it's regardless of your politics and what you think is going to happen in the election, it's hard to ignore this as a big positive. So, if there's a Biden administration, same policies, how's it going to impact investment grades, inflation, and unemployment? Well, if we have a $3 trillion stimulus plan, investment grade bonds should go lower, with the exception of municipal bonds, which should go higher because they're going to get some support and their credit spread should come down. Inflation should be higher relative to what it would be. That doesn't mean that we'll have high inflation. It means it will be higher relative to what it would be, which would also be negative for Treasury securities as they start to price in higher expected inflation. And I think unemployment would naturally be lower as all this money would cause higher employment. Raising the corporate tax rate to 28%, it would again be lower across the board for investment grade bonds of inflation, but it would cause higher unemployment, which would be great. And if you marry those two again, I think generally speaking, the stimulus would trump, no pun intended, the raising the corporate tax rate. If you raise minimum wage, it naturally causes more inflation and more unemployment. Even if it, if you think morally it's the right thing to do, it will cause higher inflation and higher unemployment. Again, higher inflation relative to where we would be otherwise. This manufacturing innovation, again, it'd be similar to raising the minimum wage. The $2 trillion clean energy would be similar to the investment grade. The $1 trillion stimulus. You would have lower investment grade bonds, higher inflation, and lower unemployment. For the Trump administration, again, when you both want to do stimulus and lower taxes is a form of stimulus, you're going to you're going to have similar results, and they both want to do this just to different degrees. Stimulus will be a negative for investment grade bonds. It'll make inflation higher, and your unemployment will be lower. So I think regardless of who's president, you might end up in a similar positive position for stocks, a similar negative position for investment grade bonds. I think just having some clarity on who the president is will be beneficial to the market overall in this act too.
And it's worth noting that you repeatedly indicated that your expectation was that consumer discretionary stocks and small caps are likely beneficiaries of a lot of that activity.
Right. And this isn't, that's what we saw. Consumer discretionary stocks definitely were the big beneficiaries from the $1,200 stimulus checks that went out to consumers during the CARES Act. So again, I want to revisit the idea that we have two markets because I do think this trend could reverse. I don't necessarily want to say that growth stocks could go negative, but they could slow down for sure. And these stocks that have been hampered without a vaccine could start to see a bid. And I think you've seen that a little bit as of late. That if you look at the top right part of the IWF chart, you'll see a pretty dramatic drop in growth in September. We've only battled back about half that, maybe closer to all of it as of this week. But certainly with more volatility, and if you look at the bottom right, it's the exact opposite story. So the market's starting to say there's going to be a time when some of these stocks that are really on sale, if you look at long-term earnings, are going to start to catch a bit. In a couple of funds, we have exposure to energy, which has held us back a little bit. When I say exposure, I mean, we don't have a huge position, but I did think it was worth addressing why I'm not abandoning it. And, just because something's gone down doesn't mean you should sell it. You should sell it if you have a reason to, right? So what we've seen in the market is we've seen incredible stability in the price of oil around $40 a barrel. But energy stocks have continued to just liquidate. I mean, they're at all-time lows. We see ExxonMobil with a dividend yield right now of north of 10%, which means that the market's basically expecting them to cut their dividend. And they don't have to cut their dividend unless they want to, quite frankly. I've taken a long look at their balance sheet, and they could continue to pay out their dividend for years without having a significant problem. So that's why we continue to own it. And I think one of these two things would have to give, right? Either stocks would have to rally based on, the fact that the thing that they're selling is priced much higher relative to their stock, or you would have to see a complete collapse of crude oil. And it's more likely that crude will rally if we have a vaccine or even data on a vaccine than it would fall. So we talked a lot about consumer discretionary and small caps being beneficiaries of stimulus package. I'm not the only one that thinks this. When you look at forward margins on the S&P 400, which is the mid cap index, and the S&P 600, which is the smaller cap index, I want you to concentrate there on the blue lines. We're seeing sharp expectations of improvement going into the next 12 months. That margins picture really moves into the earnings picture. This is consensus 12 months forward earnings for the S&P 600. Again, small caps, in 2020, the expectations around $24 a share. In 2021, the expectations around $51 a share. So this is in the forward 12 months is $44 a share. So this is almost like buying an incredible growth stock, right? We're expecting some huge growth in earnings over the next 12 months. Gold, we continue to hold gold. It's done exceptionally well. It's important to keep reminding people that what we look for is a change in relative interest rates before we move on from gold. We look at gold as a currency. But, you know, you don't want to just buy it because it's done well, is kind of the message that I want to get. So the ongoing risks, I only want to touch on them quickly because we've talked about them in the past, but I don't want to forget them. And I want to remind people that despite the concerns you might have on the election or the virus or stimulus measures, there are these other things that we need to keep in mind.
Before you go on, we did have a question. I wonder if you'd like to take it now.
Sure.
The question was, since the local and state governments have suffered reduced tax and fee income from the medical and socioeconomic effects of the COVID-19 pandemic, how important will the federal $1 trillion recovery packages be in managing these deficits without raising taxes?
Yeah, so there's a few points there. So municipalities typically do their budget in 1 year in arrears. So they can actually have a horrible 12 months and not do anything about it. And then they do it 12 months later. And what you start to see is you start to see teachers and cops and firemen laid off well after a crisis rather than during the crisis as they start to try to recover their budgets. And we saw this in the financial crisis. We saw, government unemployment being a drag on recovery for years after we hit bottom. That could still happen. It's especially going to happen if we don't have a stimulus measure. Now, the other side of it is how is it going to affect municipal bonds? So that's kind of how it affects employment and unemployment. And obviously, if you have more unemployment, it's not good for the economy. Again, the economy is connected to the stock market, not necessarily a one-for-one. I do think that's an important point. Now, what does it mean for municipal bonds? So how can municipalities continue to pay firemen, policemen, and teachers without raising taxes? Well, they can borrow the money. The municipal bond market is a very big market. It's a very liquid market. People love to invest in it. It's traded very opportunistically for us. We've taken advantage of it. And the reason why we've been able to take advantage of it is because the Federal Reserve has been a backstop. So the Federal Reserve has basically said, no matter what, if you're a municipality, if you're a municipal bond, we'll lend to you at the interest rate of 5%. Very few municipalities have had to take advantage of that rate because the capital markets are willing to fund it at significantly lower rates. There's only been two issues. One was the New York City subway system, and I forget the other one that has had to draw on the Federal Reserve's the 5% offer. And what does that mean? That means that the market is generally not concerned about the cities and state governments being able to pay their bills years out. So when you borrow money, you basically are pushing your obligation out to the future. And so hopefully when that bill really comes due, we're not in COVID times and sales tax and property taxes are higher. The good thing is we are having a boom in property tax, right, as people move out to the suburbs. So that's a plus. You think I answered that effectively, Chris?
I think so. And if not, I'm sure we'll get a follow-up question for when we get to the end of the program.
All right, so we talked about this exact slide last quarter, so I'm not going to spend too much time on it, but we have seen an increase in speculation and gambling. I know of a few stocks that I consider borderline fraudulent. The other point that I want to make here is when it comes to speculating, we look at our advantage, especially when it comes to individual stocks, as being able to buy stocks at good prices. If I was going to sum up what we do on the individual stock portfolio in a couple words. We don't chase stocks that are doing well. It's typically term, not a good strategy. We're not taking performance bonuses. We're not expecting it, we're not expected to take outsized risks that are happening in the market. Right now, 1 in 5 stocks that are have zero operating earnings or negative operating earnings have been up over 100%. Okay, so that is companies that aren't making money that have doubled this year. That is a clear sign of speculation, and I want people to be aware of it. There might be companies with great brands that use a lot, but if they're selling $1 for 90 cents, it might not be a good investment in the long run, despite how the paper trades in a given moment. And here are just a couple examples that we've beaten a dead horse on with a lot of people on how that can end badly.
In the case of Intel, I just want to point out, it's not that you're disheartened with that as a company and think ill of the company. It's simply that at the point that it took a long time when it traded more speculatively for the price to recover.
Yeah, basically took 20 years to get back from its 1999 high, 1999, 2000 high. And I think it's a good company. So you can pay too much for a good company and really kill your return.
There you go.
So this is International Risk Revisited. In 2018, 2019, we saw a lot of issues around Brexit and around tariffs. Those issues have not gone away. And on tariffs, they've probably gotten worse. On Brexit, they might have gotten a little bit better as the Conservative Party in Britain has swept both Parliament and Prime Minister, and Boris Johnson's a Conservative in the Prime Minister. So we've been optimistic about a Brexit resolution, but one hasn't happened yet. So it remains being a concern. And that's on top of the Eurozone having a whole host of other structural issues. And the relations with China have only gotten worse. So when we talk about inflation and deflation,
Brian, I want to make sure it's clear what your point is there. It's not that, it's simply you just want to remind our listeners, our clients, that these remain concerns that we're paying attention to and may ultimately impact decisions we make about the way we design the portfolios. I just wanted to kind of reinforce your point to make sure it was clear for the
100%, Chris. I think you did a good job. So, we talk about inflation and deflation. We're going to get a lot of questions about, these giant stimulus packages. What's it going to mean for the national debt? Well, how come we're not concerned about this? Well, what can happen with the national debt is it can cause inflation. And until we have an inflation concern, I'm not necessarily worried about stimulus measures in the national debt. Now, when you have inflation, it's basically because you can buy a good with cash or you can buy a good with credit. And this is a chart about the household total debt balances from 2004 until 2020. And we can see that over time during the financial crisis, we had about a $2 trillion destruction in credit. So that is partially why we had a large disinflationary economy for that time. The Federal Reserve and the Obama administration had a stimulus, and we had quantitative easing, which helped nominally to keep inflation positive, but it didn't have a huge impact. We still had a very, very low inflation number historically. Now the Federal Reserve is even taking more aggressive actions this time to keep this debt balance higher. So, but we've had a more dramatic decrease in employment and more rapid. So it remains to see what the amount of the destruction of credit is going to be going forward. And as long as the destruction of credit is offset with more actual dollars that you can buy goods with, which is what this slide's all about, we shouldn't have an inflation problem. But if we have no destruction of credit and more dollars in the form of stimulus, then we could have an inflation problem. So right now, if I expect a $2.5, $3 trillion worth of credit destruction, and we've had $1 trillion in personal income growth due to the CARES Act, which is leveled off and actually falling after the July 31st deadline, I don't have a significant expectation of inflation. Neither does the Federal Reserve. So we should be pretty comfortable with making those stimulus measures going forward. So the Q4 takeaways. As potentially have volatility, we have a lot of uncertainties here in Act 1. But the vaccine data and the resolutions of the election remove two biggest uncertainties currently in the market. So then we can get forward with moving with Act 2. So the near-term uncertainties coupled with longer-term optimism leads to a market that's currently near fair value. If we were able to snap my fingers and get a vaccine and a fair electorate, in an election that we know who won, I'd say the market should be much higher. But it's not without volatility, and we need to maintain discipline and keep an eye on long-term trends that could cause problems in the market. So, Chris,
All right.
any questions or?
Yeah, at this time, there aren't questions posted in the Q&A session, but I will invite anyone who would like to unmute their line if I'm able to do this. I'm not sure how to do that, but if you'd like to be ask a question, perhaps you could type it in or indicate in the chat area that you'd like to be unmuted, and I will endeavor to figure out how to do that. Brian, so while we're seeing if there are any other questions, I think the big picture to reiterate is, on the one hand, we have some uncertainty in the weeks and months ahead. We have the notion that the virus is likely to worsen in the near term, and that could have some detrimental impact on the economy. The notion that the election has some uncertainty around it, but with this notion of Act 1, Act 2, the other side of that is that we are likely to have a vaccine that's likely to enable earnings to improve and see the valuations change materially. And we're likely to see the opportunity that more certainty returns into our picture. And that's good for our expectations for what may come from the markets in the year ahead as compared to the weeks ahead.
Yeah, I mean, part of the way that I think about it, Chris, and you know this, that if you can see through to Act 2, and if you are in the correct risk tolerance, and we have near-term volatility, then what a great buying opportunity we're going to have to get in at lower prices to for the Act 2 optimism that we're going to have. And generally speaking, I think that's how I think about it. When it comes to portfolio changes, clients might have noticed that we have started to move into more small caps in the more aggressive strategies, and we're going to do that even more. And in addition, we've been in healthcare, and we're going to move into some consumer discretionary ETFs, the ETF mutual fund strategies, in order to take advantage of the trend that we could get some tailwinds from stimulus.
Brian, why not? We've gotten calls lately from clients asking about the idea of getting more defensive. And this has been several people have called about this. What should we get more defensive in the coming, anticipating what may be coming in the coming weeks? Uncertainty about elections primarily is what's on their mind, but also the virus and so forth. Excuse me. So, why shouldn't there be this tactical notion of move away from stocks now and then try to get in later, as opposed to this approach that you have right now, which is really starting to think in terms of looking more opportunistically and potentially ramping up and buying more if we get some dip?
Yeah, I mean, ultimately it comes down to do you want to buy before things have moved or after things have moved? And what we've seen time and time again is if people try to change their risk preference, try to sell off at one point and buying at another point, they almost inevitably end up selling high and buying low. Why? Generally speaking, it's because the market's pricing in future expectations, right? It's not necessarily looking at what's immediately here in front of us now. It's saying what's going to happen in the future. So the market's pricing in some Act 2 right now, right? It's pricing in getting beyond Act 2. So you might, it's highly likely, I'd say it's more likely than not that we could have some volatility here in the next few months, but it's no guarantee. And when we get beyond Act 1 and start to get in Act 2, it's very likely that we could be higher than we are today. And for that reason, I wouldn't want to miss out on that move. I'd want to position myself for what's coming rather than what's here today.
So keep the long view, be focused on, as a long-term investor, there will always be, whatever the day may present, there will always be bumps in the road, but be thinking opportunistically in this kind of a moment, not necessarily because we have this longer expectation that things will be opportunistic and beneficial a year from now type of mindset because of the virus maybe being more under control and earnings getting the benefit from that, some clarity in the outcome of elections, but a known quantity, and whatever the outcome, there's always certain areas where there will be benefactors when it comes to the market. So keep that long view, don't necessarily overreact, and keep in mind behind the scenes, we're making a lot of those adjustments as needed with the portfolios that we have discretionary control over.
I just want to add one last thing, Chris. You know, we say that we're going to make changes behind the scenes, and maybe other asset managers say they are, but you know, we had a recent test case where we had a dramatic change in the stock market in March, and the clients that stayed the course and allowed us to make changes around the edges. You know, I can detail the changes that we made. We made mid-quarter adjustments that worked out. We made end-of-quarter adjustments that worked out. Those clients, and they know who they are the ones that are continue to do exceptionally well. The clients that were in the wrong risk preference because they wanted to take too much risk when they thought the market was going up, and they got nervous when the market was going down, are the ones that lagged. So let's find the right risk preference for you, and let us be buyers when the market gives an opportunity rather than sellers. So, you know, that was my final note. If there's no questions.
That's fine. Yeah, no questions. My parting comment is just to invite our clients, if you have any questions, if you find that you're uncomfortable and would like to discuss what is the right mix for your portfolio, certainly give us a call, 508-771-8900, toll free 866-771-8901. We are working remotely, but that phone will reach us. You can also connect with us through the website or by email, amrfinancial.com, or you can certainly reach out to either Brian or myself by email. Thanks, everybody. I hope this was helpful for you. We'd love your feedback. If you'd like to give us insight as to what you found useful or not, let us know. Okay, we'll be in touch. Thank you.